Good morning from our global headquarters in New York. I'm Manus Cranny. You're welcome to Bloomberg Brief. Let's get setting that agenda. Stocks stumble, lowered by mega tech as JPMorgan assesses the unwind of the carry trade is now 75% complete. Focus turns to the jobless claims. It's a media blitz as Warner Brothers takes a $9 billion write-down on its TV networks. And Disney feels the pinch of the consumer in the parks division. Vice President Harris and Governor Tim Walz pick up momentum in the Midwest as they visit Michigan and Wisconsin to sell voters their message. This is J.D. Vance, mirrors the schedule. A very good morning. They say often that the road to recovery hell is paved with good intentions, and that is the problem with the equity market. The Bank of Japan gave you the cover yesterday, but what is the quality of that cover for the carry trade? We understand from JPMorgan 75% of it is already done. Perhaps the narrative is the stumbling of the bond auction yesterday, which sort of unseated risk a little bit. What I can tell you is the focus squarely on the 240,000 jobless claims today. The market thinks we could move by over 1% either way. A couple of stocks to keep an eye on. The Nasdaq is eking out the tiniest of gains. Cathie Wood is in there buying the dip. ARK Investment Management picks up some Amazon, some Meta, some Roku, some other stocks just to keep an eye on. Warner Brothers taking that $9 billion hit on the TV networks. CNN and TNT just not worth what they were when they did that over $40 billion deal a couple of years ago. Disney, the parks, consumers are not delivering at the level. Of course, this is the bulwark of Disney. They may be adding to the streaming numbers, but the parks are underwhelming. The bond market, as I say, 391 is where you are. The market shunned that 10-year offer yesterday. The bid-to-cover ratio was lower at 232 relative to the recent bid-to-cover ratios of 2.53. Let's see whether we choke on $30 billion worth, on $25 billion worth of 30-year paper today. By the way, JPMorgan moved the risk of a recession up from 25% to 30%, and dollar-yen turns it around ever so slightly. We are off a higher level of yen that we had yesterday. And again, the question is how much of this carry trade has been covered in the spot market, and are we moving to the second leg lower of that? That is the question. Here's what some of our guests have been saying about markets, the outlook, and the odds of a recession.
So Nikkei and S&P 500, reasonable, notwithstanding the hedge funds and the volatility got what they wanted, and by no means is it behind us, but the severity and the degree of it we believe is behind us.
We're still in the soft landing camp. Our point is, look, markets got spooked by the payroll last week. They got spooked by the ISM manufacturing data, but the economy is not that bad.
The market sentiment swinging to a recession with the SAM rule, etc., getting triggered. I'm still not in that camp because I think there are enough resilient factors in the U.S. economy.
Even if we have a downturn, it's going to be a fairly shallow downturn.
So it's sort of a mixed bag because I think the policy reaction function does differ across Asia, and not everyone is just following the Fed.
Context is everything. How shallow will this dip be, and have the hedge funds really got what they wanted? My guest this morning is Iain Stealey, International CIO of Fixed Income at JPMorgan Asset Management. Iain, timely to have you with me. Let's just talk about the choreography of what we've had. A job shock, a growth scare, a carry trade unwind, a vol shock and a VAR shock. I have not seen bond markets this hysterical since 1994. Has that hysteria passed?
It does feel that we're getting a sense of calm at the moment. And as you said, there was just a combination of events that occurred over the back end of last week, and then obviously starting Monday in Asia, in the Asia session, which led us to this volatility environment. But I think that we've seen some calming messages from the Bank of Japan. I think that we have heard sort of a more calming measure from Fed officials that let's not panic on this. And it does feel, as you said earlier on the segment, that a lot of the carry trade has been unwound. And actually that puts us in a better environment. And now we're in a place where we need to make a decision as to whether that jobs data report from Friday was correct. And we are seeing a slowdown in the US economy or into a recession, or actually maybe it wasn't as bad as first perceptions when we get the revisions through and when we get some of the weather adjustments and things look a little bit more bright, and we're on a sort of the sub-trend recovery that we've had for the last few months. And I think the jobs report, the initial jobless claims report today, is going to be very eagerly watched by a lot of market participants.
Yeah, and we're looking for 240,000 on the jobless claims. It will be a razor focus. Yesterday, I would say it wasn't the classic Fed put. It was the Bank of Japan. There's no irony here. It was the Bank of Japan verbal put option. But what we need to debate now is what is it that the Fed needs to deliver as it were, a soft landing. At one stage, we were talking about 5.5 cuts, a 40% probability of 5.5 cuts. Now, that has been scaled back dramatically. In your view, when you look at the backup in yields in 2s and in 10s, Iain, what's the bond market telling you now? Is it steady as she goes 3 cuts into December? Or what is it could really push them to a 50 basis point, pulling the trigger on 50 basis points?
So I think if you're the Fed, and remember the Fed took their dot plots down from 3 to 1 back in June, I think they're going to want to show that they're not panicking, and they're going to want to show that they ultimately are making a decision, not just on one data point, but on the entirety of the data, which is what we've heard from them. Now, that's not to say they can't go 50 basis points in September, and I do think it's going to be very critical when we get the August jobs report to see whether we have seen any improvement from what we saw last Friday. And if we don't get an improvement, then by all means, they should be looking at moving 50 basis points. But if they do get an improvement and they may say, actually, we're ready, we're prepared to work, we're prepared to ease policy from a very tight level, but actually the data is just trending down, they might be more tempted to look at 25. So I think it's going to be very key, that jobs report at the beginning of September. Obviously, this time is going to work in their favour. They are going to get that jobs report before the September meeting, unlike last week.
And this is the debate that I'm having with a number of people on the IB. In 2007, they did 50, 25 and 25. In 2001, which is the nearest reference point of where the market could expect something much more significant. So this is not 2007. This is not 2000. This is, by all accounts, if you take the Atlanta Fed GDP now, third quarter real GDP at 2.9%. This is about a slippage in jobs. And that's what JPMorgan, the parent for you, say. It's about job shedding. And it's a question about the velocity of that job shedding and whether that really accelerates, isn't it?
I think you're absolutely spot on there. And I think actually when you look at the jobs report, has that unemployment rate gone up because of people entering the labour market? That seems to be what we're seeing from the data. It's not coming out because jobs are being shed at the moment, particularly permanent jobs. And when we also, as you said, Atlanta Fed is showing 2.9%, and that's actually ticked up since the data last week, based on what we've seen this week. And then actually when you go through company earnings, we're not talking about layoffs. Where they're not giving us profit warnings. They're not saying that they're seeing a real downturn. They're keeping revenue and earnings forecasts in line at the moment. So again, you're completely right. This isn't 07. This isn't the tech blow up. And that was why very early this week it did seem a bit as if the market was overreacting when we were talking about intermeeting cuts.
That's why I thought it was very stoic of David Solomon to say this is not a sort of a major eruption. If you have a look at the VIX, it might be something different. And if you were in that bond market, it was a touch of hold on to your seat. Here we are. We've had a pretty solid bounce, haven't we? 2s have bounced by 30 ticks. We've gone from, 265 up 30 ticks in the space of 4 days. 10s have bounced by 27 basis points. The market convulsed yesterday on the auction. Can you put a bit of colour on that for me? Because it's an interesting, they had to cheapen it quite a bit. So what was the reticence? Because we've got 30s coming down the pike today. What was that jolt?
So I think it wasn't just the fact we had the Treasury auction. We had a lot of investment-grade credit supply as well, and that actually got taken down very well. I still think there is a demand for high-quality fixed income. I just think there's some people out there thinking sub 4%, is that really where we want to be going into these auctions at, particularly when we've got the 30-year coming up in the next 24 hours. So I do feel that there is a strategic desire for people to own duration. I think there's been a lot of duration bought over the last few days. I just think maybe people are getting a little bit concerned. Do we see a little bit of a pullback if we do get a better jobless claims print today? If we do get better jobs data over in the next print, maybe we should be thinking more 25 rather than 50, and actually yield should be a little bit higher. That's not to say we're going back to some of the levels that we saw just a few weeks ago, and I do think the strategic direction is for lower yields, but maybe they're just calling into question how quickly that can happen.
Yeah, as you say, the risk reward is still about owning bonds But those steepeners perhaps have narrowed a little bit. Iain, thank you very much. Context this morning as we go into the jobless claims numbers. Pretty important Thursday. Iain Stealey there of JPMorgan Asset Management. Other stories trending on your Bloomberg terminal this Thursday morning. Jamie Dimon says he's sceptical that inflation will return to the Fed's 2% target. The JPMorgan CEO cited risks including deficit spending and the ongoing remilitarization of the world. He expects the Fed to lower borrowing costs soon. Cathie Wood scooped up shares, as I was saying, in tech firms, caught up in Monday's market right. The ARC CEO bought Amazon, AMD, and Roku, among others, at the start of the week. Her flagship fund is down more than 20% this year. 3 Taylor Swift shows planned for this week in Vienna have been cancelled due to terrorism threats. Austrian police arrested 2 people on suspicion of planning a terror attack. Swift was scheduled to have 3 shows in Vienna, all part of the Eras tour. Now, in the middle of all this equity madness, I show you what's happening with Dr. Copper. Declined by 20% from its peak on May the 20th. You've got stockpiles aplenty in London, rising the most in 4 years on Monday. But look, the Bloomberg Commodity Index also at a 6-month low. And you're looking at iron ore. Let's have a look across the board. Iron ore is down 27%. The issues are this. You've had a growth scare globally. China is still under pressure. Copper bouncing back into the green. It dropped by $159 yesterday. So do not be beguiled by 0.25% of a rally. So the growth scares are real in the metals and commodity markets. Coming up in the show, Warner Brothers Discovery posts a multi-billion-dollar charge on the value of their TV networks. We look at how that media landscape is changing. And later this hour, we'll catch up with RBC's Laurie Calvasina on whether the US is tipping into a recession. Context matters every day on Bloomberg. It is Bloomberg Brief. I'm Manish Krenny in New York. Warner Brothers Discovery say that the cable channels, CNN, TNT, they're no longer worth what they used to be. Shares tumbled as the media giant posted weak results. It wrote down the value of those TV networks, taking a $9 billion charge. Tom McKenzie is with me. Tom, when you look across this report, yes, streaming, they're building it up, but these traditional legacy assets that they bought in the deal, they're just not up to par, are they?
And they take a charge on the back of that, Manus. That's the charge. It comes through. It's an eye-watering number, quite frankly, $9.1 billion. That deal, of course, was cemented in 2022 between, of course, Discovery acquiring Warner Media. But what they're saying, absolutely, to your point, that their legacy businesses, the legacy TV parts of that business, so CNN and TNT, are just not worth what they once were when they pushed through that merger, worth $42 billion at the time. So they take this charge, $9.1 billion. The Q2 revenues, by the way, falling 6% for Warner Brothers. If you're looking for a bright spot, for a silver lining for this business, then look at the subs, look at the streaming part of the business, because they did manage to increase the numbers by 3.6 million in terms of the subs. That was above the estimates, and they now have a total number in terms of subscribers for that streaming part of the business of more than 103 million. Ad revenues as well for that part of the business also coming in higher than the estimates. But yes, they're taking this charge. It's a reminder of the squeeze on ads and the cord cutting that continues. And the CEO, David Zaslav, basically saying, look, everything's on the table. I know there have been stories around splitting the digital assets away from the studio and one thing and another, but it does sound as if a debt pile of nearly $40 billion and a cash flow that's under pressure may well mean all options are still on the table. I just want to focus in on Disney because they posted their first ever profit in streaming, but signaled that there's weakness in the famed theme parks. Now, the company's CFO caught up with Bloomberg after posting the results.
The lower income consumers are a little bit stressed and shaving a little bit off of their time at the park. And then higher income consumers are tending to travel overseas a little bit more right now. So we really just see this as a few quarters of slight perturbation in the numbers. Frankly, I think we're going to be right back as we get into the middle of next year.
Now, I've never been to a Disney theme park. I don't know whether you have or not, but people tell me that it is ridiculously expensive at the moment. Really expensive. So, you know, this has been the power horse, this ballast within Disney to the streaming business when they were having a tough time. So has the cadence, has the balance changed within the Disney family?
Look, Manus, I was there in April, and I can attest to the cost of going to Disney, and I was there taking the kids. Look, yeah, it's expensive. They're challenged in terms of the costs. So the input costs are there in terms of wages and having to maintain the facilities. Look, this is still the part of the business that makes up 2/3 of Disney's revenues. And so when they talk about the squeeze that some of their consumers are under at the lower end, and this is how they characterised it, those people are spending less time in the parks and spending less money in the parks. And then at the high end, those with more cash to spend are just not going to the parks. They're travelling overseas to get their entertainment there. Things like the Olympics was a factor. They also talked about the relative softness, by the way, when it comes to the parks in the Chinese business as well. And they've got that park just outside of Shanghai. So this is what led to the concerns around the outlook for Disney, even as, of course, on the earnings front, this was a beat in terms of earnings and revenues, and they raised their guidance. But it's concerns about the parks. Look, again, if you're looking for silver linings with Disney, they came through the first profit in about 2 years for films, and then the subscription part of the business, the streaming part of the business, coming through with a profit for the first time, of course, of about 40 million, and ahead of those targets.
Well, of course, the CEO, they're taking sort of remedial action. 2,000 jobs went last year, and 100 jobs went at CNN last month. Tom, thank you very much, tracking the Disney trail. Coming up on the show, we're going to take a look at the other headlines around the world, including the surprisingly peaceful protests that took place across the UK. Instead of the riots that the police had feared and scheduled in anticipation for. Front page news from around the world. These are some of the headlines on the other sites. We've got the BBC. The UK's Metropolitan Police Chief celebrates, quote, a successful night after England sees mostly peaceful rallies. The country was bracing for further far-right riots after violence on the weekend, and that has been the dominant theme throughout the week in the United Kingdom. Next up, Financial Times, Google and Meta struck a secret deal to target ads for Instagram teenagers on YouTube. Now, the deal skirts Google's own rules on how minors should be treated online. Documents seen by the FT suggest steps were taken to disguise the true intent of the campaign. That story will certainly get some pretty sharp attention. And on Bloomberg, Iran calls on Israel to agree to a truce on Gaza. The Iranian president told his French counterpart that the US and Europe must urge Israel to accept a truce to reduce tensions in the Middle East. Well, let's pursue that conversation. Dan Williams joins me now from our Jerusalem office. Dan, thank you very much for joining us. So these diplomatic efforts coming from France, obviously the fulcrum of most of the political efforts have been hosted by Qatar. So what role and what heft does France have in these negotiations with the US and the others involved?
Well, first of all, France has open channels to a number of powers in the Middle East, including Israel, including, as you just noted, Iran, which would not directly communicate with Israel given several decades of open hostility existing between the countries. France also has inroads for historical reasons in Lebanon, which we would expect to be one of the ground zeros of a major flare-up of these regional tensions, should that occur. So using those ties in Iran, in Lebanon, France is one of the countries trying to weigh in, trying to intervene, trying to head off what would appear to be escalation that would take more than 10 months of fighting in a more serious direction.
It has, and the communication from this side of the pond, from Vice President or on the ticket, Kamala Harris, along with Biden, is they really are pushing towards the cause to end this conflict. What is the latest out of Israel on whether a ceasefire might be achieved?
I think we should be careful with terminology like ending the conflict. A ceasefire is, by definition, temporary, certainly when it comes to the enemies Israel faces now, be it Hamas, be it Hezbollah in Lebanon, be it Iran, or like Hezbollah and Hamas, other Iranian-linked militias in the region. As far as they're concerned, there is no prospect for peace or even diplomatic engagement with Israel. So any cessation of hostilities, any suspension would be, by definition, temporary. Now, Israel knows this. Israel feels that after the October 7th attack by Hamas on its southern towns and army bases, it feels that this was a game changer. It was definitely constituted massive losses for Israel. And Israel now, in turn, wants to change the rules of the game, meaning it insists that any truce in Gaza, that under any truce, it retain the right to resume fighting for what it would describe as the ultimate destruction of Hamas. Now, Hamas obviously does not want this, neither presumably would Hamas's allies in Lebanon, in Syria, or indeed its sponsor, Iran. So basically what we're talking about now is a stopgap measure, something temporary to stanch the violence, and perhaps let cooler heads come in and assess where to take this conflict in the months and perhaps years ahead. But why it has now resurfaced is because of the obvious linkage. World powers and regional powers are worried about what it would mean if Iran now attacks Israel directly, if Hezbollah significantly increases its attacks on Israel as part of their retaliatory actions for the 2 assassinations that took place last week, if Israel lashes out, and indeed this becomes a full-blown regional war. So a Gaza truce would not only slow or ease the fighting in Gaza, it would actually have ramifications for the rest of the region.
In Jerusalem. Thank you. From our global headquarters in New York, it is Bloomberg Brief with me, Manus Cranny. Let's set your agenda. Stocks stumble lower by mega tech as JPMorgan assesses the unwind of the carry trade to be 75% complete. Focus turns to the jobless claims today. It's a media blitz. Warner Brothers takes a $9 billion write-down on its TV networks, and Disney feels the pinch and by the consumer in its parks division. Vice President Harris and Governor Tim Walz pick up momentum in the Midwest as they visit Michigan and Wisconsin to sell voters their message. This is JD Vance, mirrors the schedule. A very good morning. The road to hell is paved with good intentions. Equity markets are struggling for a clear narrative. Cathie Wood has been in buying the dip. She's been buying Amazon. She's been buying Meta and Roku. Are you as brave? S&P 500, 5220 is where we are. Technicals seem to be part of the narrative that is holding the dam on the downside. It will be jobless claims today. 240,000 is the number to focus on. Now, when it comes to understanding the consumer, Warner Brothers are building the streaming business, but they're taking a $9 billion hit on the traditional linear TV, CNN, TNT, $9 billion hit, stock down 12% at the moment. Disney tells you something much more prescient. It is about the consumer. This stock was under pressure. The park side of the business, demand, moderating consumer demand exceeds our previous expectations. That tells you that not just are people perhaps buying less in McDonald's and traveling and booking less Airbnbs, but also pinching on the spend. The bond market is where we had a slight choke yesterday. The bid-to-cover ratio was lower than we anticipated. There was a mountain of high-grade issuance yesterday, $31.8 billion. And the question now becomes this backup in yield that you've seen over the past 4 days as the Bank of Japan delivered the covered, is that done? Or do we take another run on the downside on yield? NASDAQ coming back to flat at the moment. And dollar-yen, as you can see there, I mean, it tanked. And yesterday's pivot post the Bank of Japan, it just seems to be struggling at the moment. Is the carry trade really all undone? That's something that we can debate in just a moment. Now, Bloomberg had an exclusive catch-up with the economist Nuro Rubini on the pessimism in the market.
The markets are often wrong about what's going on with the economy and what the Fed is going to be doing. There is some significant, evidence of some slowdown of the economy, but I don't think the data suggests that we're going to have a hard landing anytime soon. If anything, actually, there's some elements of strength in the economy.
It's always special when Nouriel actually finds something good to say about the economy, hence the reason why we played it. Laurie Calvasina joins me now. She is the US Equity Strategy Head over at RBC. Good morning, good to see you.
Good to see you too.
When I find something from Nouriel which is upbeat, I'll take a hold of it. Look, there's lots of ways to look at this market. I still get the sense that there is, and I think this you too would agree with this, there's a vulnerability here.
Yeah.
How vulnerable are we to an aftershock and a ripple through?
So, I think we've got to watch the price action in here. And I know as an equity strategist, it is my job to tell you where that is going to go. But I do think the fact that we've been holding and we haven't really broken the 5,100 mark, we haven't gone down beyond 10%, I think that's a good data point in here. I do think coming into this, we were, not necessarily flagging the yen carry trade, but the idea that we were vulnerable for a lot of different reasons, I think that's all come to play this week. And obviously the yen carry trade, what happened with the economic data last week, that's all front and center. But we also had stretched sentiment on a variety of indicators that were basically telling me for a while, regardless of what the issue was, we were vulnerable to some downside. And you saw that on AAII, where net bullishness had a couple times over the last month or so gotten up above the 1 standard deviation mark on the 4-week average. That's been a very, very good sell signal in recent years for temporary kind of 5 to 10% type pullbacks. CFTC data, which comes out on Fridays, is even scarier. S&P contracts and broader U.S. equity market future contracts have been sitting above your January 2018 highs and above your February 2020 highs. I mean, it's really, quite staggering. We've been sitting there for a while this year. It's surprising to me we only did 5% back in April.
So, we're holding the line at the moment, as you say. 51 is holding the line. If I look at this story around the carry trade, and by the way, I'd be delighted to know if anybody can actually quantify an OTC FX market and say to me, absolutely 75% of this carry trade has been undone. Do you put credence with that? I mean, they're talking about the spot market.
Yeah. Look, I think that's an area, it's beyond my area of expertise. I watch the headlines that everyone else is watching. I am, feeling a little bit better, right? We've got one major bank coming and saying we're sort of late innings. For me, what I'm really watching more are the technicals. And I'm not a technical strategist, but I am listening to that community very closely. And so the fact that the technicals are kind of holding in and the market is behaving when we're, getting sort of close to important support levels, I think that's probably the best we're going to be able to do, because we're probably not going to know officially it's done until after the fact.
Look, if I look at the past 5 days, it has been about growth, it's been about policy response. I would say the shakedown was more in FX and crypto and rates, to me.
Yeah.
The equity market got some cover from the Bank of Japan yesterday, but the next leg for steadying this equity market is still going to be about the earnings, isn't it?
I think that's fair. And I think one of the reasons why, equity investors in my world, and I talk mostly to long-only folks, some hedge funds, but I would say the long-only world that's sort of caught up in the less day-to-day moves, they look at events like these, the fact that we know that there was something flow-driven, something positioning-driven, that almost makes it a little bit better, right, if it's not entirely fundamental, because I think experienced investors who have done this for many decades know you look for, babies that are thrown out with the bathwater in these kinds of situations. You look for opportunities. And I think that is why it's so important to sort of understand where we're going to stabilize. If this thing breaks 10%, it probably means we're going into growth scare territory. Those drawdowns end up being something like, kind of 14 to 19% if you look at post-GFC history. So I think there's an inclination to sort of use this as a buying opportunity, but we need a little bit more information to make sure it's just that.
I mean, if the dam breaks at 5,100, so the next leg could be to 14, could be to 19%.
Yeah.
That then brings in what is the scale of the Fed? No, the Fed is not here to defend, as I said on Monday, over-levered, AI hunting, AI FOMO investors. The Fed's job is inflation and full employment, right? But then the argument becomes what kind of response mechanism you get from the Fed, whether there is justification for 50, 25, 25, or something more substantive. And again, we haven't seen that kind of response mechanism since 2007.
Right, and if you go back and look at the history of emergency cuts or 50 basis point cuts, we did this last year at SVB. We dusted that work off again earlier this week. You really have only seen that in sort of my career trajectory. I started back in 2000. Let's rewind a little bit to 1998. But if you kind of go with like and I'm kind of a dinosaur these days.
You've got a lead on me. Let's put it that way. I've been around longer than you. Go on.
Yeah, but I was always the youngin', but like Now I'm like old. But I will say, just sort of in what I call modern market history, we only break these things out around the terrorist attacks of 9/11, the implosion of the tech bubble, COVID, the GFC.
Yes.
I mentioned growth scares earlier. We had those kind of 15, 19-ish% drawdowns, things like 2010, 2011, the U.S. debt downgrade, the sovereign debt crisis, 2015, 2016 industrial recession. Do you remember any 50 basis point cuts or emergency cuts then? I don't.
No. You say that, look, they come along in bunches, but they don't tend to settle the market nerves.
Not initially, and we have one chart, we've looked at it against the VIX, sort of these emergency cuts and these 50 basis point cuts. And you often see, volatility will continue to rise after you get the first one or two.
And I think that's what people are worried about, is if they pull the ripcord and they do the 50 basis points, what do they know about growth that perhaps we don't? Danny was here. I know that she'd want. This is homage to Danny. This is about small caps. I mean, we had the rush of blood into that July move. It really was quite strong into value, and that has somewhat dissipated. We've got a nice chart that shows this. So this was the ramp higher in value to growth. Now look, it's given it back. I mean, big growth, big mega tech had a tough time in July anyway. That is far from done.
No, it is. And
that retracement, excuse me, is far from done.
And if you look at the valuation data, so we look at the top 10 names in the S&P over time, we rebalance it. I mean, you got up to around a 32 times PE multiple heading into this, right? And then it got knocked back down. 30 has kind of been the ceiling. This cohort of the market cannot handle going above the high 20s for too long. And we've come back down into like the mid to high 20s, but the average is like 18. So we're nowhere near, sort of close to levels where you say, okay, we've pulled the valuation froth out. If you look at the CFTC data, and we'll get that on Friday, but we look at the NASDAQ 100 mini futures positioning there. The best proxy we have for sort of real-time positioning and sentiment on the mega cap growth trade. And 2 Tuesdays ago, so the data we got this past Friday, you had barely seen a decline off of all-time highs, which had matched highs that we'd seen back in February. So in terms of the kind of unwind from the positioning and valuation side, I think you've done a little bit more work on the valuation side. You've really barely gotten started on the positioning side.
I know you can't dig into individual names, but when I see moves in when I see moves in Airbnb, like I saw yesterday, when I see moves in Heineken, Delta, and Nike, the verbiage coming from them, that tells me something much more malevolent about the risk to the hedonism of the US consumer. Disney, they're not spending the same amount of money in the parks. It's expensive. Idiosyncratic information. But it's piling up.
It is piling up. I mean, I think we have to ask, what is it speaking to? So again, I think we're all watching the claims data. We're all watching the jobs growth data. I think that's ultimately what we've got to keep focused on, because we've known for quite some time the consumer, even the middle to high-end consumer, is really ticked off about inflation and reacting. I mean, we've been seeing this in company reports for a while. I have small children. I live and breathe this every day with $5 cookies that I say no to. I mean, it's just ridiculous, how much the prices have come up. And you hear a lot of talk about the cumulative impact of inflation. I think a lot of people are living and breathing that, and so you are seeing consumers react to that. We have to disaggregate that, right, from the jobs picture, because while the NFP data, I think it confused people, the weather impacts, clearly we're slowing. Do we really know that corporates are doing anything more than slowing their hiring right now? We're not seeing big pickups in things like the Challenger data. As I go through, kind of non-consumer companies, I am not seeing corporates kind of raise the red flag. I'm not seeing an alarmist tone. I'm not seeing an emphasis on cost cutting that's escalated versus what I have before.
Look, I think, as you said, we've known for quite a while that the consumer is under pressure. I think this narrative that we're sort of going to return to 2% inflation and stay there for a long period of time, that's the bigger question. It's about what inflationary environment do you, me, and your kids have to grow up with.
Yeah, I think that's fair.
Laurie, thank you so much. It's always great to get you in the seat. Laurie Calvasina there of RBC Capital Markets. My guest this morning on equities. Coming up, VP Harris and her running mate Tim Walz hitting the campaign trail. Ohio Senator J.D. Vance. He isn't far behind them. Tracking the trail on Bloomberg. Bloomberg Brief. I'm Iain Stealey in New York. A very good morning to you. Back to Warner Brothers Discovery. Parent company of CNN and TNT posted a $9 billion charge after writing down the value of the TV networks. For more on the results, Charlie Wells joins us now. Charlie, $9 billion is a heck of a write-down on those legacy assets. What's it going to mean for strategy for this company?
Yeah, Manus, it's tricky. I mean, what was really striking yesterday was that figure, but not just the figure, but how rapidly the company had to comment on that write-down, right? It was only 2 years ago that Warner Brothers and Discovery merged. And I think this is what really was sticking out to investors yesterday as the share price, dropped 9.9% at one point. As far as strategy, it's difficult. I mean, there has been a lot of chatter about the potential necessity of selling assets, but that's something that we know this company doesn't want to do. And actually, if you look across the industry, if you think about the likes of Paramount, if you think about a lot of these other big companies, they don't like doing that.
No, they don't. And I think, as the CEO sort of said, look, a lot of options are on the table. There's been a lot of speculation about splitting that company up. Let's talk about Disney, because they posted the first ever profit. This was on their streaming business. But there's all weakness on the theme parks, I should say. Here's what the CFO had to say.
The lower income consumers are a little bit stressed and shaving a little bit off of their time at the park. And then higher income consumers are tending to travel overseas a little bit more right now. So we really just see this as a few quarters of slight perturbation in the numbers. Frankly, I think we're going to be right back as we get into the middle of next year.
Of course, the CFO, telling the story that they're going to be back on top next year. But if I compare and contrast WBD with Disney, whose shares have also fallen, but by a much lesser degree. So somebody's getting something right in the streaming department.
Yeah, that's exactly right. I mean, look, streaming, that streaming unit at Disney, profitable for the first time ever. But I think what's really probably frustrating for that company is, good news at Disney and also at other companies, good news isn't good enough, right? So they had their first profitability for that unit. We even saw at Warner Brothers, improvements in streaming, and we've been seeing this across the industry. But look, it's just so different from terrestrial, right? The ad dollars are just different. Those legacy, TV properties form such a huge part of these businesses. But at least at Disney, there's strength in that unit. Interestingly, earlier this week, of course, we heard about Disney Plus prices potentially going up as much as 25%, which is going to upset some consumers. But for investors, it just shows that this company, at least, right now, thinks that they have that pricing power.
Yeah, I mean, that's a heck of a price rise, isn't it? 25%. Let's see whether the consumer chews on that or chokes. Paramount reports after the market closed today. What can we expect?
I mean, look, it's not going to necessarily be a stellar report, but all eyes really are on that deal with Skydance. And Manus, you and I have been talking about this deal, the twists and turns for the past few weeks. And I think what's interesting here was an element of that deal was this 45-day go shop period. So we are ticking to the end of that, and that would have allowed other suitors to come for Paramount. Anything could happen at this point, but I think really the focus is going to be on Skydance, because there's not a lot that this company can really do. There's not a lot of catalysts.
Okay, let's see what the numbers are. As you say, all eyes down on the strategy. Charlie, thank you very much. Charlie Wells with the very latest on the media platforms. Let's turn our attention to the White House race. Vice President Kamala Harris and her running mate, Minnesota Governor Tim Walz, took their campaign to the crucial Midwest swing states to sell the voters their message on the economy. Meanwhile, the former president, Donald Trump's running mate, Ohio Senator J.D. Vance, was hot on their heels in Wisconsin to attack the Democratic ticket. Let's bring in our Bloomberg law reporter, Diego Erez Munoz. Diego, good to have you with us. So Walz and Harris really out there bolstering the message with the unions. This is critically important pillar of support. What do we know about their stances on labor? Is it materially different to the Biden presentation? He was on the picket lines with the unions during the auto strike. He was there front and center. How co-joined are Harris and Walz on this?
So I don't think it's materially different. I think Harris and Walz will certainly try to, if elected to office, would try to continue Biden's labor agenda. He has called himself the most pro-union president of the history of the United States. And I believe both Harris and Walz would try to continue that record. Walz, particularly over the last 2 years since Democrats took over the Minnesota State House, has passed a series of longtime Democratic priorities for labor policy, a comprehensive paid leave program. He has signed a ban on non-compete agreements. He has also signed stricter workplace safety laws for warehouse workers and child labor. So the unions like him. They were quick to support his pick after Harris made it. The UAW, the AFL-CIO, both were very quick to endorse him. So the unions are very happy with this decision.
Yeah, I'm just looking at the Washington Post article. Harris and Walz rallied more than 12,000 boisterous supporters outdoors, while Vance appeared to have a handful of workers at an aviation factory at an event very much designed for the media. Let's just talk a little bit about the strategy here, because Vance is on that trail, mirror image of the vice president and her running mate. I mean, what do we know about this as part of the strategy? What was the narrative from him?
So Vance and former President Donald Trump are both also looking to get that labor vote. That labor voters are a key constituency in those Midwestern states that will prove crucial for the election in November. And Donald Trump, when he won in 2016, had that constituency. So I think he wants to repeat that. And Vance certainly has had a more pro-worker rhetoric than other Republican candidates. But I think the concern for a lot of unions, when speaking of former President Trump and J.D. Vance, is that once Trump did come into office in 2017, his policies were mostly similar to former Republican presidents and were not as union friendly. So I believe that they're taking a lot of what former President Trump and J.D. Vance say on the campaign trail with a grain of salt.
Okay, Diego, thank you so much for joining me this morning. That is Diego Arias Munoz of Bloomberg Law. Coming up the show, earnings, economic data were focused razor sharp on the jobless claims. Context matters every day on Bloomberg. Good morning from New York. Bloomberg Brief. I'm Iain Stealey in New York. A look ahead for today. We have earnings from Eli Lilly and Novavax before the bell. And then it really is all eyes down for those jobless claims. The initial jobless claims, 240,000 is what we are expecting. Continuing claims, 1.871 million. So that is going to be a real focus for this market post that jobs number last Friday. Expedia and Paramount earnings will hit the tape after the bell. Some micro movers for you. This is a pretty big one. Bumble, plunging after the dating app says it's slashing its annual revenue outlook despite the overhaul. Warner Brothers, we talked about that several times this morning, down over 12%, $9 billion charge on writing down their traditional TV assets. And Occidental Petroleum raised their production and their capex plans for this year, closing at $10.8 billion acquisition for Crown Rock a little bit earlier this month. Stock is up 0.7%. I want to show you the S&P 500. Laurie Calvasina of RBC has just sat in the seat with me. Critically important, 5,100 is going to be your line in the sand. That slips over and flips over from what she would refer to as a potential holding the line on a 10% drawdown to a growth scare. And in that event, you're looking at a traditionally 14 to 19% drop in these markets. All eyes done on the jobless claims today. Good morning from New York.